Ladies and gentlemen, good day and welcome to the Q2 FY24 earnings conference call of Aditya Birla Sun Life Asset Management Company Limited, hosted by InCred Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jignesh Shial from InCred Equities. Thank you, and over to you, sir.
Thank you, Michelle, and good evening, everyone. On behalf of InCred Equities, I welcome all to Aditya Birla Sun Life AMC to QFY24 earnings conference call. We have along with us Mr. E. Balasubramanian, Managing Director and CEO, Mr. Parag Joglekar, Chief Financial Officer, and Mr. Prakash Boogle, Head Investor Relations. We are thankful to the management for allowing us this opportunity. I would now like to hand it over to Mr. E. Balasubramanian, Managing Director and CEO of Aditya Birla Sun Life AMC, for his opening remarks. Over to you, sir.
Thank you and good evening to everyone. Also for the introduction for this call. I hope you all had the opportunity to go through the earnings presentation, which is available on the stock exchanges and our website. Let me quickly give you the broad economic outlook and the mutual industry update before I give an update on our performance for the quarter 2 of 2024. Broad economy, the growth story for the country as a whole remains intact and resilient despite global macro uncertainties. The latest quarterly GDP release at 7.8% was robust and broad-based, and economic conditions remain favorable with various high-frequency macro indicators, including capex gaining ground and strong GST collections and PMI numbers, and better capacity utilization and credit activity, all of them leading to a reasonably good positive outlook. And also what lends more credence to the strong growth outlook is that it is unfolding while maintaining macro stability parameters and a strong global headwinds. The Indian markets have experienced a widespread recovery, which was demonstrated by the Nifty 50 recently achieving a significant milestone, and the inclusion of India in the JP Morgan Emerging Market Bond Index has further elevated India's global perception and signifies substantial progress for the economy on bond flows as well as interest rates and rupee gaining strength. The festive season has started in full swing on a cheerful note, which is poised to drive higher consumption in India and uphold the strong positive sentiment in the market. The domestic economy is structurally strong with sound fundamentals and is expected to withstand the recent geopolitical volatility as well as the market volatility they have witnessed recently. With respect to the mutual industry, as of 30 September 2023, the Indian mutual industry quarterly average AUM grew by 20% on a year-on-year basis, reaching 46.98 lakh crore versus 39 lakh crore as on 30 September 2022. During the quarter, the industry witnessed net equity sales of about 99 crores through new fund offering and also the existing funds. And within the existing funds, the hybrid categories, arbitrage, small cap, sectoral and thematic funds, multi-asset allocation funds, multi-cap and mid-cap funds saw the highest net inflows. The mutual industry also witnessed good inflows coming to the NFO collections to the extent of about 22,000 crores. The industry SIP flows grew by about 24% year-on-year from 12,976 crores in September 2022 to 16,042 crores in September 2023. The total number of mutual investors also stood about 15.9 crore investors with an increase of 14% on a year-on-year basis. The individual average AUM grew by 24% on a year-on-year basis and contributed to 59% of the total AUM, and B30 cities accounted for an average of about 7.5% of the total industry AUM. Coming to the ABSL AMC performance, in Q2 FY24, our overall average assets under management, including alternate assets, reached 3,24,000 crores, growing by 10% year-on-year compared to last year. The mutual fund quarterly average AUM has crossed 3 lakh crores, as I mentioned earlier, about 3.25 lakh crores, and quarterly average assets under management also crossed 1.3 lakh crore size. SIP flows have increased from 931 crores of last year to 968 crores in September 2023, with an overall folio count being somewhere around 80 lakh folios. In our overall mix between individual and institutional customers, individual investors account for about 52% of our assets. In the recent months, our business has been proactively pursuing many strategic initiatives in order to drive, one, the future growth, and second, the market share loss that we have seen. In order to address that, there are certain steps that have been taken. In fact, the steps that have been taken have also been yielding a positive results, which I would like to highlight as follows. On the investment side, most of our equity funds are not only beaten the benchmark in the respective category on a one-year basis, but also the peer average with the higher margins compared to the last few quarters, which gives me confidence that our equity fund performance, which is a bit lagging behind, are coming back with changes that we have made. We also strengthened our team by bringing in co-CIO equity very recently, and which has come on board, and it's also likely to drive the broader investment processes, as well as work along with the team to take the aims to the next level. And furthermore, we also given growth to our internal talent, who have been part of the system for a good number of years, had larger responsibilities, now take on the greater responsibility in the fund management side, while they continue to serve as a senior analyst for a few large sectors, which are key to the overall economic growth. Under the guidance of our CIO overall, Mahesh Patil, these changes have brought in new vigor, confidence, new energy, and poised to enforce momentum into our efforts to expand our equity assets further. On the fixed income side, the team led by Kaustubh and Srina have always remained committed to lead the fixed income space with robust performance and also create a strong presence in the fixed income market. With the global bond yields reaching their highest levels in over a decade in developed markets, US bond yields are about to approach 5%, which will offer an attractive entry point for investors looking to invest in US dollar assets. And to seize this opportunity for our investors, we have, as I speak, launched a fund of fund investing in US Treasury ETF, providing a powerful tool for diversification and investment. Additionally, on the domestic front, addition of global bond indices by JP Morgan also provides an opportunity to investors to consider fixed income as an asset class for them to invest. We identified certain products in this space, given the view that interest rates remain higher for longer. Therefore, we'll continue to keep high focus on building the fixed income space and identify new opportunities in order to build our retail participation in the fixed income product offering. Our strategic efforts across various channels to enhance our market presence have delivered favorable outcomes in this quarter. In fact, we started a campaign called Focus Fund Offer, basically combining the existing funds, which has got a greater acceptance in the market. At the same time, those products have also got a long-term performance to back it up, and has yielded a positive results and gained good traction in the marketplace. As a result, we have seen an upswing in those funds, it is FO fund, what I call it, in key numbers on various parameters, especially the gross sales and other things. We have seen good improvement, which again reflection of that the focus that is bringing in on building our retail is something should yield results. At the same time, the sales ecosystem that we created to support the entire retail initiatives, such as the virtual relationship manager, Sampark, and service sales RM's responsibility, and also digital distribution, has also been yielding results as the time progresses. Coming to our alternate and passive business, our passive business offerings grew by about 68% on a year-on-year basis to touch 28,400 crores as on September 2023. And has also been growing our customer base to about 5.4 lakh folios. Our current product offering in this category runs to almost about 40 products as it stands today. On the AIF front, fundraising is underway for ABSL's India Special Opportunities Fund Category AIF, which have recently launched on the lines of success that we had launched in the AIF product with service-oriented funds. On the back of that, we have product pipeline to launch in this area as well. After setting up our GIFT City, as we all know that we are the first one to take initiatives in the mutual industry to create our presence in GIFT City. In fact, we have launched the industry first ABSL Global Emerging Equity Fund. This strategically feeds into emerging market equity fund of global boutique investors, enabling our investors to access and benefit from emerging market opportunities. We have closed this fund as the first tranche we have closed, and we garnered close to about $11.2 million assets in this fund. Of course, now it's open for subscription for getting incremental money. Our upcoming product pipelines include ABSL Structured Opportunities Fund in the Category 2 AIF, as well as Index Linked Fund in the Category 3 AIF. That's something the product pipeline we have created in order to build the alternate business, one to get more customer base, as well as improve the overall profitability coming from the alternate business as well, including PMS. Moving on quickly to the financial number for the quarter. Revenue from operations for Q2 FY24 was at 335 million versus 350 million versus 311 million in Q2 FY23, up by 8% on a year-on-year basis. Operating profit for Q2 FY24 was at 1,811 million versus 1,728 million in Q2 FY23, was up by about 5% on a year-on-year basis. With this, I would like to conclude and open the floor for any questions and observations that we may have on the current strategy as well as the future strategy. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Dipanjan Ghosh from Citigroup. Please go ahead.
Hi, good evening, sir. Firstly, to data keeping questions, if you can give the SIP AUM number for 2Q and 1Q, and also the overall employee base for 2Q and 1Q. Second, if you can just give some color on what is the current payout in the market and your yield or net yields in equities on the blended book versus the incremental yields that you're getting on fresh business. If you can give some color on that. And lastly, you mentioned some points on strategies that you adopted to kind of stabilize your SIP market share. So if you can give some color on incremental trends in October and November, and what are the strategies, if you can outline some of them. Those are my questions.
I'll just ask the first question to be answered by Prakash, and on the margin front, I'll request Parag to answer. The last questions I'll answer.
Dipanjan, the SIP AUM for the Q2 FY24, which is September, is 60,814 crores. And for the last quarter, it was 57,543 crores. The number of employees in September is 1,437, which was 1,449 in last quarter.
Thanks, Parag.
Dipanjan, the yields on equity remain more or less similar in the range of around 70 basis. And the yield on new flows will be in the range of around 55 to 60 basis.
If I have it correctly, 55 to 60 bips on fresh, right?
Yeah. So we generally share around 65 to 6% of the total DCR. So depending on the scheme it comes, generally it will be in the range of around 55 to 60 basis.
Got it.
With respect to Dipanjan on the SIP strategy, in order to support SIP strategy, we did launch a series of the SIP product, such as Sampurna SIP that we just launched. As well as few other features that we created. In fact, the entire retail team is focusing on building size in that thing. That is why we have also seen in our overall SIP incremental basis, there is an improvement in terms of ticket size. Is again coming from coming from the Sapurna SIP that I started, though it's just a small number is coming in. That's something you have done. Second is having seen improvement in performance, we also of course working closely in terms of the schemes that one get upgraded from external rating point of view. Already seen one of our large cap fund have moved up in star rankings, which essentially reflects on improvement performance, which also of course get featured in various platforms, use this data point for pushing the product. And second, we also engaging with the online platform, which of course have been quite aggressive in terms of building a SAP book very recently. We have been having engagement with them and see the improved performance of equity schemes, where all it can fit in on various categories, done some analysis, and basis which we're also engaging with them, which I think gives me confidence that yes, we'll see some improvement coming in that space. And third, of course, is given the fact that the markets have been quite volatile recently. I think SAP is something which we continue to believe that the best way to participate in SAP. Therefore, increase the engagement level with all our partners, especially MFD partners, who have been also contributing quite a lot, as well as some of the national distributors partners, more than the banks, have been contributing quite nicely in the SAP book. And these two engagements that we have done in the recent past, I think all the three of these activities that I just mentioned about should help in actually improving the overall the registration, therefore the gross number improves, as well as the net number that currently we are about 970 crores. I think the number should cross 1,000 crores kind of number to start with and then move up in the rank. So that is why we are doing it. Of course, we also launched one NFO as I speak. I just started today, which is the Transport and Logistic Fund. And normally what happens is NFO 1 not only gives the incremental AEM, it also gives a new customer base. It also helps in getting new SIPs, and that's something should help. Even the US bond deal that we have started, of course, it's in the mutual fund platform. It does not have any restriction in terms of what is the minimum ticket size, and we can participate. We're also seeing some kind of really good participations coming in the fund also from retail side. So all these initiatives makes me feel that I think we will see some the combined effort should see that improvement coming on the SAP space.
Sure. Balaka, if I can just squeeze in one small question. If I look at the industry and where incremental SIPs are coming from, and if I look at your market share losses, can you give some color on what would be your counter share across all the major channels? Like you mentioned that you're working closely with the digital partners. So, if you can give some color on what the mix would be internally, or where you are probably seeing some pressure, or where you're kind of probably higher than your blended market share. If you can give some color on that from a channel perspective.
Yeah, just on the broader basis, there are 5 channels. One, of course, IFAs. Second is the bank, and third is the MFDs, and fourth is the digital, and fifth is the direct. In terms of the channel-wise contribution, the significant contribution on incremental basis is coming from the digital platform. That's something we are saying. Of course, various strategies they apply that we discovered, what are the strategies that they apply, and basis which we can engage with them, give them some kind of input in terms of where our product can feature, basis which we can actually get some incremental market share. That's something we have already been working on, which includes Grow, Paytm, PhonePe, Kuvera, and so on and so forth. The other channel, direct as a channel on incremental basis, also contributing. In fact, we set up a separate team of people, of course comprising about 30 people to drive our direct. In fact, we have seen a contribution from this team on a quarter-on-quarter basis is showing good results. And also we have set a target for each of the branch locations to also keep a high focus on direct as a business building and as part of your customer expansion strategy. That's something is contributing to the industry, and even for us is something we are setting our focus. Third, of course, is the IFA channels continues to remain. active, but of course incremental growth from all the traditional channels is not as what we are seeing on the digital platform and direct platform. So that is something one we can maintain our strategy on the traditional channels. These are the two channels also we are revisiting how we can get a higher market share in this space, for which we are taking some steps as you just mentioned.
Got it. Thank you, sir, and all the best.
Thank you. A reminder to all the participants, anyone who wishes to ask questions may please press star and 1 now. We'll take the next question from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, good evening, sir. So just firstly on your product launch pipeline, so what are the products that can be envisaged in the say next couple of quarters?
Yeah. One, of course, we already started the fund. We have launched one currently. The two funds which are currently open. One is the US bond yield fund, which is 1 to 3 years and 3 to 10 years duration. We were the first one to launch this product to provide an opportunity for Indian investors to participate in the best of the story in the world. And reasons are, of course, known. Largely the yields are high, and other benefits that could come in terms of any potential appreciation that would come next year. That's something we have done. And this product is going to be open-ended product, though it's a new fund we have launched now. And after the closure, it will be open for subscription. And as you know, that total limit that's available for this product for the whole industry is about $800 million. And we have a limit of about $200 million in the space. And hopefully, we should be able to utilize this space quite extensively. The second is Transport and Logistic Fund. They already been having a roadshow across the country, and we were the third or fourth one to launch this product in the space. Again, we see purely on the basis of India story, this product has got longer term shelf life, and therefore we launched this product, which again started today, is likely to close on 10th of November. And third, of course, we have AIF product pipeline that we have created. Given the fact that we had good success on the first AIF launch that we have done, currently close to 900 crores, we have created two pipelines in the space, one special structured opportunities fund in category 2, as well as index linked fund for category 3 fund. These two we are doing. And fourth, of course, is subject, of course, getting clearance from SEBI. We have planned a quant fund with head of equity coming in, with Harish Krishnan coming on board. We also plan to have a quant-based fund, which again will be driven by the CIO, co-CIO equity, supported by a quant manager whom we also recruited and will be likely to be on board very soon. These are the immediate product pipeline that we have, and as we see an opportunity, especially in thematic category, we'll continue to keep that as a focus. As we know that given the fact that we are a 30-year-old fund and the various categorization of schemes have been given, we'll have a limited scope for new fund offering, but still within that we'll operate in terms of looking for opportunities and launch some funds.
Thanks. On the yield front, the yield improvement in this quarter is primarily because of the mix and right, there's nothing else to it.
Yes.
Anything on the debt side where the mix has changed and has acted favorably?
Yeah, there is slight uptick in the debt side also due to mix and generally opportunity to have a little higher income. So there is a slight uptick on debt side also, and the other reason is the mix change towards the equity.
Yeah.
What would be the debt yields in the quarter?
Debt yield will be around 24 to 25.
20 basis points. Yeah.
Okay. And on the SIP front, we in the last couple of quarters, our monthly run rate has been much low, has been declining rather than in an industry which has been hitting new highs. Would you ascribe only that to only performance, or what else is playing out there?
One is mixed, I would say, Prayash. I think To give you some color of the past, I think we have been pioneer in building SIP for very long in the Indian mutual fund industry, even much ahead of most of the key competitors in building SIP is a way of building our business. Therefore, we had huge subscriptions coming almost about 5 years back, and then they would have held for about 5-7 years, and very ahead of time. So that's one. Therefore, the incremental AUM from each one of them would have, of course, gone to some other people as well. And second, of course, we did go through 1.5 years of equity performance lagging behind competition. There's been the last 1.5 years that also led to significant contribution coming from some of the online platforms which I mentioned about it. I'm only happy to say that as I gave a quick briefing on how the steps that we have taken in terms of building back the performance, which I'm happy to say that we are seeing a significant improvement, which ultimately should lead to improvement on the overall participations from all channel partners, which again I am seeing it in terms of acknowledgement. First one, that industry, the participants should acknowledge, yes, the performance are on track or back on track. And secondly, of course, willingness to give is always is there. And these two things going well, I think we should see that coming back. As I said, online platform always goes by certain certain models. That's why you would have probably seen the rate of growth for the other than top 10 is much higher than the first 10. It's also coming from the fact that SIP registration also comes to the NFO's offerings, also contribute to the overall success. It's not just coming only in the existing fund. It also comes in the new fund offering. It's a combination of these three. So, but net, I think our renewed focus that we are bringing on few areas, I think should help us in building back the momentum for that.
This last question, how has been the NFO commissions, particularly for your newly launched NFO, and how has been the trend in the industry?
Yeah, trend in the industry.
We haven't launched anything currently, Prayesh.
Okay. But what would be the trend in NFO commissions in the industry? Whether because we've seen in the first half there was some relief, and all the AMCs had been talking about some cognizance about commissions. Is it inching back again, or how is the trend?
Generally, it will be slightly higher than the normal sharing which we do in the normal sales of our existing fund. Because NFO generally you estimate some amount and generally accordingly pay the brokerages, and depending on the collection, which the amount differs, but it will be slightly higher just because it's a new fund offer. So to create that traction, it's slightly higher than the other existing one.
Yeah. One advantage that we get on the NFOs is your expense, of course, starts with a higher slab, and as the size becomes bigger, it goes down. To the extent the payout will always be favorable to the distribution community, no doubt. But still, at the end of the day, the broad principle that we have, it is to make the product more profitable in whichever way is possible. At the same time, remain remunerative for the distribution channel, and yet doesn't become too costly for the investors. These are three combinations put together. We keep doing that. I think that more or less remains from a strategy point of view. And anyway, we are supposed to operate within the overall TR guidelines that under which all of us are supposed to operate.
Okay. Thank you so much, and all the best.
Yeah.
Thank you. We'll take the next question from the line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah, good evening, sir. Thanks for the opportunity. So, sir, just a question so last quarter we have highlighted that we have selected a pool of schemes where we have seen improvement in our performances, and our flow market share has been improving. So could you tell us what is the strategy over there? Have we added any more schemes over there, and what is our gross flow market share in the last 3 to 4 months over in those schemes particularly?
Yes, Lalit. What we did is one, the basket of product which we wanted to build size. At the same time, acceptance in the market is also very high upon the longer term performance and style of managing these funds, and also relevance of this product that we have seen an improvement such as a large cap fund and flexi cap fund, as well as small cap fund. Even a small cap fund we have seen inflows into the small cap fund, though the flows would not have been as big as some of the my other key competitors would have seen, but at least on an incremental basis we have seen inflows, and that also being reflected in the form of overall gross volume on these schemes improving, which again reflection of how the focus strategy also is working. And even moving forward as well, we will keep identifying the product that has got one, acceptance, and at the same time from a relevance point of view it remains. And third, of course, we can also build volume. That's something as a strategy we keep applying it, and that should actually lead to both improving the gross sales contributions as well as the net sales contribution.
Yes, so just a follow up in this, like, so within these schemes, like currently, what would be our qualitatively, what would be our gross flow market share in the last 3 to 4 months? Like, what, if any, quantification could be helpful?
Yeah, no, generally we don't, of course, disclose this number because it's not specifically is given out anywhere. But I can only say that what we have seen in the previous quarter, from the previous quarters, almost we have seen an improvement of about 3 to 4% on an average out of these three schemes.
Sure, sir. And so secondly, on the expenses side, so we have so during the quarter we have seen that on a sequential basis it has remained in the same range. So like, what is the outlook on the expenses for like FY24 for the remaining 2 quarters in FY25? Like.
So Lalit, the expenses have gone up slightly on the people side. This is mainly due to the increments which we happened in the month of this quarter. That has resulted in slight increase in that, and the other expenses has gone up on the fees and commission, which was towards the AIF commission which we had paid, which is getting amortized over the period. So this is the main changes. On people side, I think so it should remain in the similar range, or if there are any hiring which we do, then slightly may go up, but otherwise should be in the similar range.
Yes. Yes. Thank you.
Yeah. Thank you. Yeah.
Thank you. Participants who wishes to ask questions may press star and 1 on their touchtone phone now. We'll take the next question from the line of Abhijit Sakhare from Kotak Securities. Please go ahead.
Yeah, hi, good evening. Just one question in terms of the steps that have been taken. Any other major gaps that need to be filled in either on the talent side or on the distribution side?
I think 1 or 2 areas, of course, we have keep looking at improving the contribution. One, of course, on the retail side, bringing in, I think we did have we had seen some talent attritions as it always happens for an industry. Therefore, that one part remains a high focus area. Second is beefing up the team, especially on the credit opportunities that we are seeing. We have, of course, the 1 member team. We are looking at building the team so that we can offer more product in the fixed income space, especially to invest in credit-related opportunities. That's something we are beefing up. And third is our offshore contribution has remained somewhat flat for quite some time. Once again, given the fact that India has been in the forefront in getting inflows from overseas, again we're revisiting our strategy in terms of what are the incremental steps that we can take both on the people as well as on getting assets from some of the mandates that we already have a similar mandate whether we can win from others, from institutional investors base, and how the GIFT City can actually help us in building the space. That's something we are working on it. And these are the key steps that we are taking. And skill of course is our ongoing thing. There is no specific one that we do. The talent identifying and bringing some external talent wherever there is a need. And then both of course go hand in hand. And that's something we are thinking it's more of an ongoing stuff. Therefore, I don't have anything specific to give on that phase. And on the investment side, of course, last time also I mentioned that we will further strengthen. And what we have done already, giving the internal existing talent, highly skilled internal existing talent, and bringing external talent, and both the combinations we already done as far as the mutual fund investment space concerns.
Got it, sir. That's helpful. Thanks a lot.
Thank you. Before we take the next question, a reminder to all the participants, anyone who wishes to ask questions may please press star and 1. We'll take the next question from the line of Devesh Agarwal from IIFL Securities. Please go ahead.
Thank you for the opportunity, sir. First question, sir, is slightly on a macro thing. In the past, we've been talking about financialization of household savings, and some of the recent data is suggesting that there is a reversal in that trend, and net financial savings has seen a dip in terms of within the household. And so in that light, how do you see, although we understand that the flows have been pretty strong for the equity segment over the last 3-4 months, but going ahead with this trend that we are seeing, and also the interest rate on FDs being pretty high, do you see any risk for the inflows into the equity segment?
Yeah, I think interesting, Devesh. While the view of course keeps getting formed, linking to the market, definitely one thing that seems to have got established for the industry, even for ourselves, I think SAP way of investing is gaining more and more strength. I think if I just look at it on a broader basis, if I add up the number contribution coming from SAP, the number coming from NFOs, and then number coming from existing schemes, increasingly the contribution coming from SAP has been going up, and the lump sum investments have not been growing as much as which normally grows, which again reflects one on the view on the market, at the same time conviction of products in equity for longer term point of view. That's why it's coming to the SAP. That I see is a trend emerging. Second is we still have a lot of untapped investors base. Whatever certain time we have only 4.2 crores, 4 crores unique customer base, and we as a fund house have got about 52 lakh unique customer base. And these numbers can easily double in the next few years, given the fact that interest rates have been quite high, but not as high as somebody to divert the money from equity to fixed income, FDs and other things. Therefore, the wealth creation aspiration still remains. Therefore, I believe equity will continue to be attractive from investors' point of view. But of course, if there is a correction in the market, any sharp corrections generally I've seen historically, it puts a brake on the flows, and SAP generally get slowed down, which we have seen historically. We have seen after many crises, after every crisis in the past. I would assume this time I'm not ruling out similar trend will exist, but only thing this trend could be a little better than the previous trend that we have seen. Therefore, I don't see a significant dip in terms of growth. But one area where we see the household savings could potentially come into the mutual fund space, despite the tax benefit not being there, which is the fixed income space. The carry in fixed income schemes have been pretty good, ranging from 7.5% to about 8% kind of carry. And we also have a view that interest rates will remain higher for longer. We are setting up a focus in terms of in the current market conditions. Its fixed income could also be one good suitable opportunity for investors. That's something we are pushing it. Therefore, we will probably see increased participations coming both in the fixed income space as well as in the hybrid space, like multi-asset allocation fund is something which invests in all the 4 asset classes. Again, people would like to use this as a hedge for any equity market volatility. That is what something I see is overall momentum. And lastly, today if you look at in the 42 lakh crore, a significant proportion of assets coming from equity, and any normal basis, it could be 50-50, it could be towards equity and debt, or maybe in some conditions it could be 45-55 towards equity and debt. Assuming that the kind of asset allocation model gets set in, then naturally other asset classes will grow a little faster if the momentum of the equity market gets altered for any unknown reasons.
Understood, sir. Sir, you did mention that given the increased contributions coming from SIP flows, the overall stickiness is kind of increasing of the net flows into the equity segment. I just wanted to understand, based on the kind of investors that we have, generally what is the tenure for these SIPs that gets opened up? And if tomorrow, this is again a hypothetical question, if markets were to fall say by 10-15%, do you think that the stickiness will be there, or there could be some churn in terms of these investors not reopening the SIP? And to that extent, the SIP flows can also be at risk.
Sure. See, I think one of the areas where I think people like us who have been building SIP for quite some time with the longer term goal in mind, definitely those assets will be sticky. That's what we historically have seen. But we must also accept the fact that all the incremental large subscription is coming in through the online platform. It will be largely good mix of millennials and first time job, the first time job kind of people who get employed. These are the people generally also tend to move away from the market if their experience doesn't meet up with their own expectations of making quick money and so on and so forth. And these are some of the trends I think will always evolve. My belief is these investors also learn lesson from these kind of behavior of the market, and therefore they become a long-term investors when they come back to the market once again for the second time. So that is what historically I have seen, and this trend I don't think we should also rule out from SIP is being cancelled. It normally happens, but as long as the macro acceptance and the what do you call the registration numbers keeps rising, even if the cancellations, I don't think we should worry about it because those guys again I have seen them coming back in the market. Maybe it comes from a delay, but of course I see it coming back to the market also after some time. But millennials, probably what you said is right. Millennials would always test the water for some time, and they may tend to cancel it and then restart once again.
So any number that you can share of this 15,000 crore flows that we see on a monthly basis, how much would be coming from this online channels or millennials?
That I mentioned, I think for the quarter, the motamota number I saw it was about 37 or 38% were coming from online platform. Basically the digital platform. Roughly about 39% of various channel contributors I mentioned about, the traditional channel and then digital channels and direct channels. The digital channel has suddenly become the large contributor. Again, I see it coming from these millennials, youngsters coming on board, 1,500 rupees, 2,000 rupees kind of ticket size, and they generally tend to buy and sell kind of behavior will always be there. That is the way I see it currently. Of course, one good thing is the way I see is positively, new customer additions definitely ultimately they become a permanent investors for the mutual funds as time progresses.
Understood. And so we read this morning that SEBI is thinking about this high risk fund. Any thoughts around that? What is exactly is this, and what kind of assets would be? And do you think there is a strong case for investor interest in this kind of category?
No, the very fact that AIF fund has been created is to create a separate category for all the risk takers, which is meant for say accredited investors kind of investors. Therefore, I'm not paying currently much weightage to the article that came in. Given the fact, I don't think we are having a part of the discussions at this point of time to have such kind of product in the mutual fund space. Therefore, I'm not very sure how much of the weightage I have to give for this.
Okay, understood, sir. And lastly, sir, on our channel mix, we've been seeing more or less the contributions have been steady, especially if we talk about on the equity side. The national distributors are around 20%, banks are around 10%. Given that you said that incremental money is coming from fintechs, do you think there would be any channel mix change that we should expect over the next, say, 1 to 2 years? And would that have any impact on our yields?
No, from a channel mix point of view, I think definitely MFDs continues to remain a dominant player, and so they anyway focus on long-term investing and handle customers during all period of market volatility, and ensure they make their investors invest for longer-term goal purpose. I see that continues to remain among the traditional channel. MFD will remain a dominant player, absolutely no doubt on that. Incremental wallet shares will continue to come from them. Second, of course, the national distributors who have a deep presence, all India presence, and continue to stay focused only on building retail will remain a powerful channel. Banking, of course, again, they have a larger focus on wealth management business. They will again remain a dominant player, no doubt on that. Of course, incremental AUM coming from the digital channel and direct, which again increased focus is coming in. Definitely the contribution on a year-on-year basis compared to these channels will definitely be higher. Therefore, the higher the growth compared to the normal rate of growth coming from other channels, if it continues, which is what I also feel will remain, then naturally the contribution will accordingly undergo a change. But that doesn't mean it will come at the cost of other channels. At the end of the day, more channels contributing to the success of the industry will only help the industry to grow on an overall basis, and the wallet share of each of the channels will continue to rise, and people like us should also get to participate in this overall contribution coming from all the 5 channels which I mentioned about.
Okay. And so this digital or online channel that you mentioned, these are booked under the national distributors or MFDs?
No, it comes separately. It comes in MFD, sorry. RAs and MFDs. Some of them are MFDs, some of them are RAs. It comes in the RAs things. The RA and it will come in the direct side, sorry. If it's RA, it will come in the direct.
So it's a direct and MFDs.
Public domain. I am just giving you broader sense of what we keep track for ourselves.
Understood. Perfect, sir. That is all from my side. Thank you so much.
Yeah, thank you.
Thank you. As that was the last question for today, I would now like to hand the conference over to Mr. A. Balasubramanian for closing comments. Over to you, sir.
Yeah. And thank you everyone for joining, and with this we conclude our Q2 FY24 earnings call. Do feel free to reach out to our Investor Relations Officer, Mr. Prakash Bogle, for any queries that you may have. Thank you and happy weekend.
Thank you, members of the management. Ladies and gentlemen, on behalf of InCred Equities, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.